Good morning. Today is Tuesday, September 24th. I'm Joe Terril, president of Terril & Company, private wealth managers located in St. Louis, Missouri. This is another video update for our clients and also our contemporaries that follow our thoughts on the economy, interest rates, inflation, and the investment markets. With me is Russ Phillips, our main analyst on equities, and Dave Carter, our main analyst on fixed income. And I want to start, fellas, by pointing out to people that the Fed surprised us a little bit when they cut the short-term interest rates by 50 basis points. This is a little bit more aggressive move by the Federal Reserve Bank than what we anticipated. And if you believe what Chairman Jerome Powell of the Federal Reserve said at his press conferences, they're going to be aggressive in cutting interest rates between now and the next 9 months. And of course, this is a risky strategy on the Federal Reserve Bank's part because it can reignite inflation. And this has happened in other industrialized countries in the world where not only after their interest rate cuts did inflation come back, but they've actually gone back to raising interest rates. So the short-term interest rate that was around 5 3/8, 5.5 is now around 4 7/8, 5. If the Fed cuts again come December meeting, our projection, Dave, and I'm going to go to you in just a moment, is still that we think the short-term interest rates in the next 6 to 9 months is going to bottom out somewhere around 3.5%. But that doesn't necessarily follow through that a 10-year government bond that's been around 3 3/4 since the Fed cut interest rates, it's still 3 3/4. For a while this morning it was trading at 3.80. Those yields have not gone down, and after 2.5 years of an inverted yield curve, we're back to a positively sloped yield curve. So Dave, if you will, why don't you just chat for a few minutes with our viewers about what we're doing in the fixed income aspect of portfolios.
Yeah, thank you, Joe. And yeah, it's been a very dynamic market with the Fed news in that. And when people talk about rates, they talk about the Fed funds being front and center. And the 10-year is equally, if not more so, important for the investment markets. And the 10-year really has not gone down, and in fact it's gone up a slight. I think it's 15 basis points since the Fed cut, and we are seeing the inversion of the normalization of the yield curve with longer rates with higher yields. And so what we're looking at right now, and since our prior call, that really hasn't changed. We're looking at reset notes and floating rate notes, and those investments have performed very well given into the rate cut. Prior, we could get 6.5% to a reset out 12 months to 18 months, 2 years. Today, that's 6%. That's still very attractive. And upon the reset date, if those are called away or taken away from us, we're very happy with that. If not, our coupon will be reset at a higher rate than we're being paid right now. And so we think that's a very conservative place to be, where we can receive higher than average income and have some tax advantage to it also. So that we find that attractive currently. And it's helped our portfolio with income and some slight appreciation.
Thanks, Dave. Appreciate it. Yes, even the pure floating rate paper that's not reset paper is continuing to perform well, as I think the strategy that some investors are looking at is, and we're in that camp, interest rates are not going to plunge all the way back down to 1% or 0% with a 10-year bond at 2.5% is not going to happen. And therefore, some of this floating rate paper is still going to be very attractive. Certainly our prices are up. We are a week, no, next Monday ends the third quarter of the year, and our performance is excellent, and part of that is due to the equities that we hold. So Russ, I'm going to turn to you and ask you, why don't you tell our viewers, if you will, what's happening with our equity holdings. Certainly they're moving higher in price. So bring us up to date on equities, Russ.
Thanks, Joe. And you are correct, equities have been moving higher. With the Fed's most recent decision to cut 0.5%, that adds kind of fuel to the fire, right? We have more liquidity out there chasing stocks. The old saying comes to mind, don't fight the Fed, and I think you've seen that. The Fed and the equity markets are really taking a cue from the Fed that the Fed will kind of be that Fed put or save the day, for lack of a better word. As far as our portfolios, we've had good performance. We've had excellent performance in some of the gold stocks we own. Most recently, Newmont, and we've done some management calls there, which we think that will continue. We've also seen that 493 stocks kind of rotation, which we've been expecting, right? You've seen names like AT&T and Verizon that we own do very well, and not to mention, to David's point, they pay very good income. So the rotation, we've started to see that, especially since this Fed 0.5% cut. You've seen small caps do it. You've seen small caps do a little better. You've seen a catch-up play in the equal-weighted S&P, and some of the Magnificent Seven stocks. They've done okay, but the rotation has been to other names, those other 493 stocks.
Thanks, Russ. And what we mean by the 493 stocks in the S&P 500, it's been dominated recently by just 7 major stocks that some people call the Magnificent Seven. The 493 became very reasonably priced in the last year. We have bought quite a few of them, so this rotation has really helped the stock prices, because now people are gravitating towards these companies, and we think that will continue. The economy that everyone is following so closely, we think is going to continue along in a very nice fashion. We are not in the recession camp, and we also think inflation is a long way from over, and there's a real risk that inflation could come back. Thus, we are overweighted in the portfolios with gold stocks and gold holdings, but we're going to continue in that fashion, because they are also very reasonably valued right now based on how much cash flow they're going to generate and their ability to ultimately buy back their own stock if Wall Street doesn't begin to value them at higher prices. So with that said, Brian Curtis, who produces these videos for us, thank you, Brian. And we'll try and be back in another 2 to 3 weeks with another video update on our thoughts. Thank you.